Okay, welcome back again to our financial reporting class. Tonight, we're going to be starting analysis and interpretation of financial statements, which takes around 20% of our exams. So your exam is usually between 15 to 20 marks every diet. So it's a very important topic. So when it comes to analysis and interpretation of financial statements, you would obviously be given a financial statement, usually a statement of profit or loss and a statement of financial position for you to analyze. And in this context of analysis, which analytical tools do we use? Majorly for your exams, you're going to be using ratio analysis. Ratio analysis majorly, though that is not the only tool available for analysis and interpretation of financial statements. We have cash flow statements. There is cash flow statements. You can even use trend analysis and other tools that are available to analyze and interpret financial statements. But fundamentally, at your level, the tool that is often asked in your exam is ratio analysis. So I won't be defining ratio analysis to you. We'll definitely demonstrate them with the available ratios that we have. So let me go straight to categories of ratios that we have that can help us to analyze and interpret financial statements. There are 5 of them. The very first is profitability ratios. Then we have liquidity ratios. Then we have efficiency ratios. Thereafter, we have solvency ratios. And finally, we have investors ratios. So these are the 5 categories of ratios that we have that helps analyze the different aspects of the financial statements. The first one, which is profitability ratios. So majorly, the ratios here helps assess the profitability of a company, or let me say, the financial performance of an entity. And the ratios here are, so which ratios do we have here? A, we have return on capital employed, which we call ROCE. B, we have gross profit margin. We have operating profit margin. And there's one they call net profit margin. You can even have asset turnover. There is also cost of sales ratios. There's cost of sales ratio. And also we can have expense to total expense ratio. There could be more, really. These are the popular ones that we usually have. And there is also one, I just want to mention it. You hardly use it, is return on equity. Return on equity. So The first one, which is return on capital employed. See, this ratio measures the proportion of profits or the amount of profits that is generated from the capital invested by the investors. It can also be described as the percentage return to investors on the amount invested into the business. So basically, this ratio measures how much return an entity is able to give back to its shareholders. How much return are we able to give back to our shareholders? That's what this ratio majorly looks at. And it is calculated as, so this ratio is calculated as its profits all upon capital employed. Multiply by what? 100/1. So these profits, which profits are we talking about here? So which profits can we use? So the profit here can either be, is either we are using profit from operations, which we call, let me call it profit from operations, or you can call it PBIT, profit before interest and tax, or we can use profit before tax, or we use profit after tax, which is also called profit for the year. These are the three commonly used profits when you want to compute your capital employed. You see, if you use profit from operations, from operations, your capital employed must, it's not a matter of choice. This is where the examiner is waiting for you. When you're computing ROCE, let me put this as ROCE. When you're computing ROCE and you're using profit from operations as your profits, your capital employed must be equity plus your long-term debt. It must be your equity plus your long-term debt. Or if you're using just your PBT, then this can just be equity. This can just be equity. This can just be your equity. And also, if you are using profit after tax, your capital employed can also just be your equity. So why this categorization? So is there anybody in this class who knows why, if you are using profit from operations, your capital employed will be equity plus long-term debt? If we are using profit before tax, your capital employed is just equity. And we are using profit for the year, your capital employed has to also be just equity. Does any of you have insight into why? Okay, nobody. So the reason is that this profit from operations, PBIT, belongs to, in fact, is a profit before you pay interest. Before you pay interest. So, an interest to whom? To debt holders. So, this profit is a profit attributable to both our shareholders, who are equity, and our debt holders, who are the long-term debts. So whenever, in fact, in some question, the examiner will tell you that use capital employed as equity plus debt. If the examiner says use capital employed as equity plus debt, then make sure you use profit from operations. If the examiner tells you that use capital employed as just equity, then don't use profit from operations. Make sure you use PBT or PAT. PBT or PAT. Okay. In some other instances, you might be using your total asset and all of that. I don't like doing that because that can get a little complicated in the sense that you know that when you have equity plus debt equals, you know that in this case we are saying long-term debt. In the equity plus long-term debt equals your total assets, equals your assets, equals your assets minus current liabilities or short-term debts. So in some instances, if we don't use this can also fly us because they are the same. And you see, if you are using equity, if this one goes to this side, if it jumps to this other side, this plus becomes negative. So if equity is similar to total assets minus total liabilities, which is synonymous to net assets. Okay? But it's easier to work with equity and long-term debt. It's easier for you. You won't make mistakes like that. So that's your ROCE. Then the second one, the second profitability ratio is gross profit margin. This ratio measures the amount of gross profits that is made on every 1 naira of sales. The amount of gross profits that is made on every 1 naira of sales. It is computed. It is calculated as gross profits all upon your sales multiplied by 100. That's your gross profit margin. It measures the amount of gross profits that is made on every 1 naira of sales. That means if you sell your product for 100 naira, and you're making a gross profit of 20 naira. So that means you're making 20 naira on every sales. So if you express that in percentage, and that's your gross profit margin. So it will be expressed it's usually expressed in percentage. And of course, the higher the better for this ratio. The higher the better for this ratio. Yeah, the higher the better. And again, from an analysis perspective, what makes this ratio even better is if a company is able to manage its cost of sales. Because the lower your cost of sales, the higher your profit. So we can interpret it from that angle. But for your level, interpretation is minimal, right? So you just need to know what this ratio measures and also basically be able to know the formula and know whether it's beneficial when it is increasing or when it is decreasing. This one is good when it is going up. That's what we favor. That's what shows that a company is profitable. The next one is operating profit margin. Again, this ratio measures the amount of operating profits or PBIT that is made on every 1 area of sales. And it is calculated as operating profits divided by sales, again, multiplied by 100 over 1. So is the amount of operating profit you make on every 1 area of sales. Then the net profit margin, similar to the above, this ratio measures the amount of net profit that is made on every 1 area of sales, and it is calculated as that will be profit for the year or profit after tax divided by the sales. Of course, multiplied by 100 over 1. Then your cost of sales ratio, again, this ratio measures the amount of cost of sales that is incurred on every 1 area of sales, and it is calculated as, okay, I've given you a lot of formulas. Do you know how we would calculate cost of sales ratio? Can anyone try? How do we compute cost of sales ratio? Anyone? Very similar to gross profit margin is cost of sales over sales. And it's computed as cost of sales over sales. And again, is the amount of cost of sales incurred on every sales. So, which therefore means that if you have a gross profit margin of 20%, if you have a gross profit margin of 20%, it therefore means that your cost of sales ratio will be 80%, because gross profit is sales minus cost of sales. So if your gross profit margin is 20%, which means that you make 20% on every sales, that means your cost of sales is 80%. That's what it means. So it's like a mirror image of one another.
Hello, sir.
Yes, Salam alaikum.
Good evening.
Good evening.
Please, on the cost of sales, can you explain again? Thank you, sir.
Yeah, I said it measures the amount of cost of sales that is incurred on every sales. So how much cost you incur on every sales. So if you sell goods for 100 naira and your cost of sales is 70 naira. So that means on every sales, on every 100 naira sales, you have incurred 70 naira. So if you want to express that in percentage, that's cost of sales ratio. That's 70 over 100. That's like 70%. So I was now comparing it with gross profit margin. That if your gross profit margin is 20%, that your cost of sales ratio will be 80%. Because that's the balance. Your gross profit is sales minus cost of sales. So if gross profit is 20% of sales, cost of sales is definitely the balance of 80%. We have asset turnover. And what this ratio measures the efficiency in the utilization of an entity's asset. Or it can also be described as the number of times an entity can convert its assets to sales. The number of times an entity can convert its assets to sales. And it is calculated as sales all upon total assets. This one is not multiplied by 100 because it looks at the number of times. How many times you are able to convert your assets to sales or revenue. So those are the profitability ratio that we have. These are the profitability ratio that we have. Please give me 1 minute, sorry. Okay. So the second category of ratio is we have liquidity ratios. And these ratios here measure the availability of liquid assets by an entity to settle its short-term obligations. So, and the ratios here are, so majorly, liquidity ratio looks at, does an entity have sufficient liquid assets? These are majorly short-term assets, majorly assets that can be easily converted to cash to settle its short-term obligations. And what are the ratios here? We have current ratios. We have current ratios. We have quick ratio or acid test ratio. And also we have cash ratio. These are the three common ratios that we have for liquidity ratio. And when we say current ratio, this ratio measures the availability or the capability of an entity to settle its highly short-term liabilities with its short-term assets. And it is computed as current assets call upon current liabilities. So usually we expect the current asset to be 2 times the liabilities. So the higher the better, majorly. So if your current asset can cover your current liabilities twice, that's a comfortable cover for any entity. So it's okay for any entity to be at this level of 2:1 for current ratio. Then we have quick ratio or acid test ratio. This ratio measures the same thing as current ratio, just that it is a better measure. It is a better measure in the sense that, you see, I said this ratio measures the availability of highly short-term assets. So acid test ratio is even looking at even more short-term assets than that of current ratio. More like assets that can easily be converted to cash, right? Availability of highly short-term assets to settle an entity's highly short-term liability, in the sense that if the liability should come knocking today, we should be able to sell some assets and be able to settle the short-term liabilities. So it looks at current asset minus inventory all upon current liabilities. So conventionally, this is the formula. But the idea of quick ratio is that we are removing any short-term asset that cannot be easily converted to cash, which goes to show that even within your current assets, if there are other assets that you know that you cannot easily convert to cash, like prepayment, for example, in real life, we will remove prepayment because it's not something you can use to settle liability. So we remove it. It's not highly short term at all. You have prepaid. You cannot go and meet the person and say, give me back my money. You're not expecting cash flow from that end. So we usually remove it, right? Along with inventory. When we are doing analysis in real life. Whatever. So number 3, which is the last one, that looks at cash ratio. And this one is the best measure of liquidity because this ratio measures the availability of majorly cash and cash equivalents to settle highly short-term liabilities. So what this guy looks at, so how do we calculate it? It's calculated as cash and cash equivalent all upon current liabilities. It's calculated as cash and cash equivalent all upon current liabilities. So those are liquidity ratios. We have also efficiency ratios. And the ratios here measures how well, let me put it simply, how well an entity manages its working capital. How well is an entity managing its working capital? How efficient are you in the management of your working capital? And the ratios here are, we have trade receivables in days, or we can also call it trade receivable turnover period. We have trade payables in days. We can also call it trade payables turnover period or creditors in days. We have inventory turnover period, or we can simply put it as inventory in days. So these are the major efficiency ratios that we have. The trade receivables in days, this ratio measures the number of days it takes an entity to collect its money from receivables. And it is measured as trade receivables all upon credit sales multiplied by 365 days. the credit sales here, you don't necessarily have to start calculating credit sales. You can simply use the sales given in the question directly. You don't have to start stressing yourself about credit sales. And of course, the lower this ratio, the better. You want to collect your money very fast from your debtors. The second one is your trade payables in days. And this ratio measures the number of days it takes an entity to settle its creditors. And it is measured as trade payables all upon credit purchases or cost of sales multiplied by 365 days. If this ratio is increasing and the entity has poor liquidity ratios, this indicates that the entity is delaying the supplier's money because it does not have the funds to run its operations. So you see, why I'm mentioning this is that I hear that, especially in your PM or in your FM, they will tell you that you should delay your supplier's money so that you can invest that money in something else. So that you can invest that money in something else. That is good to delay. If you have not taught you, I'm sure they will still teach you and say that to you. No, that it's not right. It doesn't even work like that in real life. It doesn't work like that in real life. So even if you want to delay your supplier's money, right? It would definitely mean that maybe you're not ready to restock or the supplier's period for you to repay the credit time given to you hasn't expired, right? But even if the time hasn't expired, you should not delay. You should pay him so that you can buy another goods because people that are in business, they want to sell very fast and quickly go and restock. I want to buy and restock. So, and if you don't pay the guy, he will not give you another goods. He will not. In fact, he won't even wait for you to finish selling before he will ask you to pay him. So delaying supplier's money does not really work in any ramification. So if we see that this ratio is increasing, what we usually look at before we make judgment, because it could be that the supplier is giving you an extended period, maybe because you are doing well. So we will usually compare and go and look at the entity liquidity ratio. If the entity has poor liquidity ratio, which means that the entity is suffering from cash flows, it doesn't have money. So delaying or an increasing trade payables in days ratio would then indicate that they are delaying suppliers' money because they don't have money to run their operations, which shows a serious issue for any organization as it were. It's a serious issue. So it's better you pay your suppliers as early as possible so that you can get more goods and continue to operate in business. Another one is inventory in days. But at the same time, it's a function of if you have money. If you have not sold, if you have not sold, there's no way you can pay your supplier. So it's a function of how fast you're able to sell. So usually it now depends on your ability to negotiate an extended period from your supplier. So if you negotiate an extended period with him, then it's good for you. It gives you leverage, it gives you time to sell. Then it is the money that you recover from selling, then you can use it to pay. So we would usually want a scenario where my receivables in days is even shorter than my payables in days. That's an ideal situation. That's an ideal situation because it helps you plan. It's the money you get from a customer that you are going to use to settle your. It should not be other way around. That your payables in days is now shorter. You sweat because where will you get the money to settle your payables? So collect money from your receivables, use it to settle your payables. Then we have inventory in days. This ratio measures the number of days, it takes to sell our inventory. So how long it takes us to sell our inventory, and it is calculated as my closing inventory. Don't use average inventory, use closing. It's easier for you. All upon my cost of sales multiplied by 365 days. So this will give me my inventory in days. And these are the efficiency ratios. So you see, there's something we can make from these three ratios. So what we can make from these three ratios is called an operating cycle. And you see, this cycle, this is also called a cash cycle or a working capital cycle or a trading cycle. And it is the number of days it takes an entity to start and end a business or a transaction. How long does it take you to start and end it? That period, or it is the period between the purchase of inventory from a supplier and when we receive cash from our customers. So the period between when you purchase inventory from a supplier And when we receive cash from our customers, of course, which ultimately we are going to use to settle our supply, that period is an operating cycle. So, see, this cycle, the shorter the better, because it shows that you'll be doing a lot of business. So the shorter this cycle, the better for the entity. And how do you calculate operating cycle? How do you calculate operating cycle? So it's computed as follows. It's computed as your trade receivables in days. This is number of days all upon, plus your inventory in days minus trade payables in days. The accumulation of these three gives you your operating cycle. And when an entity has an elongated operating cycle, it is an indication of overtrading. Something we call overtrading. When your operating cycle becomes too long, then we can say you're overtrading. So overtrading occurs where an entity is doing too much too quickly with very little resources. It does not even have the resources to back it up. So it's doing too much too quickly with very little resources. And these are the indicators of overtrading. Number one, this is what shows that an entity is overtrading. Number one is there is a sharp increase in revenue. So you see in a year, the revenue can just increase by times 10, like a ridiculous increase in revenue. Number two, you see a sharp increase in finance costs. You see their finance costs to increase steeply, to increase very fast, indicating that they are borrowing a lot of money. And because their revenue has increased, most likely they become more profitable, resulting in a sharp increase in taxes. So they will pay more tax. Also, you also notice that there is an increase in PPE, because for them to be able to achieve that sharp increase in revenue, they will have acquired assets. For them to be able to achieve this, and also you will then see that there will be a sharp increase in receivables, because they are selling, they just want to sell, they just want to do turnover, but people are not paying. People will not pay. They're not selling to the right customers. They are giving too much discounts. They just are encouraging people to just come and buy, 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 but they can't recover their money. And you would notice that there is a nil cash position. And that nil cash position has now turned to negative on the other hand, in the sense that you see a sharp increase in bank overdrafts and loans. You see that they are majorly financing their operations with loans. And of course, they don't have cash flow. You see a sharp increase in trade payables because they won't be able to settle. They will not be able to settle their payables. So these are key indicators of overtrading. So of course, these are major problems. It won't make sense for me to list all these problems and not suggest the way out. They can ask you in the exam. They can give you a statement of financial position and ask you to identify whether this company is overtrading and what has caused it. I mean, when the guy wants to do too much too quickly, is usually what have caused it. He's buying because what causes overtrading is when you're buying too much. You have invested a lot of your cash flows wrongly. All right, you have invested a lot of your cash flows wrongly. I mean, in a situation where you went to buy a lot of assets, you're borrowing and all of that. So it becomes a problem for you. So when you result in a situation where you now don't have money again. So we will now be seeing symptoms like revenue high, receivables high, payables high. All these things are ballooning, right? Then what does he need to do? Simple, right? Simple. Majorly, what this guy needs is cash flow. Okay, cash flow. So you as a consultant, of course, you'll be a student in the exam hall. You need to find a way to set up meetings with the major stakeholders that is in trouble with. And the very first is how to recover money. How to recover money. So if I want to look at it, we have listed the problems here. This finance cost, it needs to have a sit down with the bank. And now we can restructure loans. So discuss with the banks on loan restructuring. And you know that when we say loan restructuring, we're not saying the bank will not collect their money back from you. We are saying that, okay, please, can you extend the repayment period and reduce the interest rates or the amount of interest you will pay? Okay. That, okay, help us reduce not just interest rates and the interest amounts. So they can say, okay, your interest has accumulated to 50 million. Okay, you can just pay 10 million. But your principal, of course, nobody is going to reduce that, except you want the bank to close down. They have given you other people's money. So it's not possible that they will not collect their principal. Otherwise, they will just liquidate some of the assets that they have as collateral to recover their loan. So it's important you have a sit down with them that can they help you extend the repayment period and also uh, reduce the interest. Again, this sharp increase in PP, you're already in trouble. You need money, right? There's no point maintaining that PP. So you can advise the entity should should dispose the PPA so that I can make money and start settling people, payables, the bank, and all of that. Otherwise, he'll be in trouble. He can liquidate his business. Also, these receivables can engage a factor, can engage.
Hello, sir.
Yes,
Please,
Florence.
the PPE, what's the full meaning?
Sorry. Property, plants, and equipment. Yeah, sorry. So, but these are things that I will still teach you. PPE, property, plants, and equipment. It's like fixed assets. That's like fixed asset. So, again, number three, you can engage a factor. This factoring company to help recover the receivables. So that's what factor does. Of course, they will get a fee. And in fact, there are some factor that will be ready to give you money. They'll be ready to give you money. And they will say, okay, I'm going to give you 80%. Then they will go after the 100%. So the 20% will be their own cut after they have recovered all the money. So depending on the agreement, really, especially by the time they look at the caliber of receivables and they are sure that they will get the money back, they will give you advance. So you can engage factor to help recover the receivables. Okay, Solomon.
Yes, please. What's the factor?
Oh, like I've explained, they are factoring companies, okay, that help recover loans. We call them factors, okay, not factors of production. So let me write it in full. A factoring company. We call them factoring company. So their work is they help companies to recover money from customers. That's what those factoring companies do. Okay. So you can engage those ones to help you recover your money from your receivables. You can do a deal with them. What again? Also, number four, that one is E, the entity. Number four solution is that the entity can or should negotiate an extended credit term with suppliers. Okay? We should have a sit down with them and ask them to please give me some time, I'll pay you back and all of that. And ultimately, the entity should try and raise equity capital. What you need now is equity. You can see a shareholder or an investor that will give him money. That solves this problem. And raise equity interest. Can't say equity capital, that's tautology. Okay. I mean, on a more practical note, if a company like this comes to meet you and say you should invest in it, would you invest? A company that seems to be facing a lot of issues. Would you invest? All right, Tosin.
Yeah, depending on other factors, right? So Obviously, sometimes you've seen the problem, and some companies they will later pull out. So since they can increase their their revenues, and also that is a good start that they have a market. So depending on the circumstance around that, before you can say you want to invest or you don't want to invest. So it might be okay. Is it a long-term investment? Are you looking at it as a long time, or you want just to do a short-term investment with them? So it depends. That's my own view.
I mean, and that's a very brilliant view. So, I like that. So, I mean, you would most likely invest from the way you have spoken. I think I will too, similar to your observation, because for them to be able to pull a sharp increase in revenue, that means there's a market for their products. So, what they lack is money, is funds, which is why they are going to borrow money to fund these things. In fact, I will give them money to buy more PPE to sell. Just that they need to reduce the way they are selling to customers, because their major problem is the fact that these customers are not paying. If these customers were paying, that solves their problem. That's why engagement of a factor is very important to help them recover that money. So it's really a company worth investing in because they have a huge market and they will do very well if they have the appropriate cash flow. Nice one, Tosin. All right. So that's efficiency ratios. Now, the next category of ratio is actually solvency ratios. And these ratios measures the stability of an entity and its ability to continue to operate as a going concern. And its ability to operate, to continue to operate as a going concern. So majorly, this ratio looks at the level of debt that an entity is exposed to. Okay, majorly. So this ratio looks at the level of debt, and it's long-term debt majorly, that an entity is exposed to. So now, and the ratio here are, so basically we have gearing ratio. That's the most important ratio here. Then we can have debt to equity ratio. We can have debt ratio in itself. Then we can have interest cover ratio. Sometimes they call this leverage ratio. Leverage ratio. Sometimes they call it that. So these are the solvency ratios that we have. So the gearing ratio or leverage ratio, this ratio measures the level of debt that is present in an entity's capital structure. So it measures the level of debt that is present in an entity's capital structure. And this ratio is calculated as below. is calculated as long-term debts, usually interest-bearing debts. Okay. And when I say interest-bearing debts, we really mean it. So don't go and, if you see long-term debts, don't go and pick debts like deferred tax liabilities or provisions. Don't consider those ones as when computing your gearing ratio. They are not usually considered. So, all upon long-term debts plus your equity times 100/1. So, if it is too high, it's not good. Even though there's nothing wrong with having debt in your capital structure, but when it becomes too high, like this one, when this becomes, it goes above 50%, it means that the company is highly leveraged or highly geared, and it exposes the company to financial risk. And financial risk is in two ways. The risk that the interest payment will become too high, and to be unable to pay, and it will be unable to pay at all, and which will result in liquidation. So it can result in liquidation, or he is able to pay, but the equity holders will suffer. He will not be able to pay dividend to those ones. Those ones will not be happy, and they will sell his shares, which will eventually affect its market capitalization. So it's a double-edged sword. Either way, you will be hurt. Either way. So when debt is too high, interest becomes too high, becomes overbearing, and it's either you're unable to pay and you face liquidation, or you can pay, but your equity holders might suffer, except if it is an highly profitable company, which has a lot of liquidity. Then that's fine. That's okay, right? But if the company is highly profitable and it has a lot of liquidity, then maybe you should settle those debts if it has that much money. If you just settle them and probably why borrow when you have that money to run your business with your own funds? It's better to use equity funds, you know. Then debt to equity ratio, as the name implies, is debt to equity. Okay. So this is calculated as, there's nothing too much to say in this really, because it measures the same thing as gearing. It looks at the level of financial risk you faced with by putting debt and equity side by side. Okay, so it's calculated as long-term debts all upon equity multiplied by 100. So side by side. So if your debt is higher than your equity, so you'll be having a ratio that is higher than 100%. You're in trouble. That company is in trouble. So it clearly means that your operations is majorly financed by debts. That's what it means. If your debt is higher than your equity. It's only banks that are allowed to do that because they hold customer deposits, and those customer deposits, yes, they are liabilities, but it's not like that's liability they use to run their operations. Those customer deposits, based on their operational model, they're supposed to give it out to those that want to borrow money like that, and they use it to create value in the economy. But for a normal company that is not in financial services, your debt to equity ratio should be within a manageable level. Then we have debt ratio So this ratio measures the proportion of debt financing an entity's assets. So is debt over asset. This ratio measures the proportion of debts, that is used to finance an entity's assets. It is calculated as below. Is total debt, majorly long-term debt, all upon total assets times 100. So this is how you compute it. Finally is interest cover. And this ratio measures the number of times an entity's PBIT or profit from operations can pay its finance cost or interest, can pay its interest. So of course, the higher the better. It shows that you're highly profitable, and you won't be exposed to financial risk if your interest cover is high. It means the company will not be exposed to financial risk. But the thing is, you know that as good as this ratio is, it does not really say a lot, because there are some companies that will be very profitable, but they don't have cash flow. They are profitable, but they don't have cash flow. So in such cases, it becomes a little challenging. Then this ratio will not really show so much. Then you need to then, instead of profit, you can use operating cash flows, cash from operations. So this is computed as below. Is PBIT all upon interest paid or payable. That gives us a sense of our interest cover. And we have investors ratio. These are from the name. It is useful to investors. And the first ratio here that I want to look at is dividend per share. And this is calculated because this ratio looks at the amount of dividend paid to each ordinary shares, and is dividend paid all upon the number of ordinary shares. Is dividend paid divided by number of ordinary shares. Similar to that is earnings per share. Earnings per share. And this is calculated also as below from the name earnings per share, EPS. This one is usually shortened as DPS. This is usually shortened as EPS. So EPS is amount of company's profits attributable to each ordinary shares. So it's usually measured as profit for the year minus preference dividend. We want to remove our preference dividend payments divided by, we call it weighted average number of ordinary shares. Weighted average number of ordinary shares. That's the earnings per share. There is also dividend yield. This is calculated as below because really this actually looks at the actual returns to shareholders. The actual returns to shareholders, and we usually measure it as dividend per share all upon dividend per share all upon market price per share, in the sense that let me let this make sense to you, in the sense that if you have company A and company B, and the dividend per share of company A is, let's say, 5 naira, and company B is 2 naira, you will say company A is better because it's paying higher dividend per share. But you then discover that the market price to buy the shares of company A, you will need 6 naira. To buy the shares of company B, you only need 2 naira. Then it will hit you that it seems company B is better because if I buy more of their shares, I'll make more money. If the money I will invest in this guy, if I invest it in this other guy, I will get 100% return. I will get 100% return. So this guy is better. This guy is better because I'm investing 2 naira, is giving me dividend per share of 2 naira. This one I'm investing 6. It's giving me less than 100% return. And that's what dividend yield does. So even dividend per share, yeah, it shows how much dividend you're paying. But what actually tells us, gives us a sense of your return is dividend yield. Okay, it's dividend yield. Again, we can also look at earnings yield as well. Earnings yield, that means don't judge just by dividend earnings per share. Judge by the yield. Judge by the yield. So how do you then compute this? Again, it's computed as earnings per share divided by market price per share. That's your earnings yield. Then we have dividend cover. So this looks at the number of times your dividend can actually pay, not your dividend, your profits can pay your dividend. So it's usually earnings per share over dividend per share. Okay, Solomon, you have a question?
Yes, it's not even a question. I just want to confirm. So, under D, that's earnings yield, where we can say market price per share could also mean MPS, yes?
That's correct.
Okay, thank you. Just needed to confirm that.
Okay.
Thank you.
Yeah. So the dividend cover is the number of times your earnings can pay your dividend. Of course, the higher the better. So it shows that you are a company, if you can cover it as conveniently as possible. And we also have price earnings ratio. Price earnings ratio. And this usually look at, from the name, the price that shareholders place on your earnings. The price that shareholders place on a company's earnings. And it signifies the confidence that the market has on your company. If they place an higher price on your earnings, your P/E ratio will be high. Your P/E ratio will be very high if they place, and that means they have confidence in your earnings. And this is usually attributed to companies that are technology companies that can scale, that they believe will scale and will become huge in the future, will become a big thing. And that's why a company like Tesla that is not selling as much as a company like Toyota is doing, but is much valuable, much more valuable than than the value of Toyota. Or even Mercedes-Benz. If you compare Mercedes-Benz with Tesla, you see, let me even check. Let me check valuation of Benz, of even be able to, of Toyota in 2025. What is this nonsense? Okay. They are valued at 64.7 billion. Valuation of Tesla in 2025 is valued at $1 trillion. $1 trillion. So just hold on. I want to check the quantity of cars sold by Tesla. The quantity of cars sold by Tesla in 2025. How many did they sell? They sell 1.6 million vehicles. It was even a decrease from 2024. So let me see the quantity of cars sold by Toyota. So Tesla sold 1.6 million vehicles. How many did Toyota sell? So Toyota sold 2.5 million vehicles in the US alone. In the US alone. So why is then Tesla measured or valued at $1 trillion? And Toyota is just $64.5 billion. Why? It's the shareholders, it's market sentiment. So they believe that even though Tesla is not doing as much sales today, their earnings is not as much, but they believe it can scale because of their operating model, because of the way Tesla operates. When you buy a Tesla car, it doesn't stop there. You continue to pay some sort of subscription. They have apps within their car that you can subscribe to. It's just like if you are fixed into Apple ecosystem, there are a lot of subscription based. They can ask you to start buying storage. There's Apple Music, there's Apple TV. There's a lot of things that they can key you into. The same thing as the model used by Tesla. But once you buy a Toyota car, that's it. That one-off payment is that one-off payment. It does not even get spots. If you use. That's it. That's all. So again, I'm just trying to put some practical insight into this so that it can help you to remember it in the exam. So it helps companies to, P ratio looks at the confidence of the market in a company or the valuation that the market plays on a company. For those of you that are doing FM, when they are teaching you business valuation, one of the bases for measure valuing a business is P ratio. You can use it to get the value of a company. So how do you then compute it? So this is calculated as below. Is market price per share. So Solomon said MPS the other time, which is correct. All upon earnings per share. Even from the name of the ratio itself, you can use it to remember this price over earnings. Price over earnings, and it measures market confidence in a company. So the higher, the better. A company with IP ratio shows that the market plays very high price on their earnings. So we have dividend payout ratio, which measures the proportion of earnings that is paid out as dividend. And this is calculated as below. Is dividend per share, which is your DPS, all upon your earnings per share, which is your EPS. So that's your dividend payout ratio, proportion of your earnings that is paid out as dividend. Then the opposite of that is retention ratio. Retention ratio, which is the proportion of earnings that is retained. So this is calculated as below. So that would be your earnings per share. Solomon, you can, I think I can see your hand. You can ask a question.
Yes, please. What do you mean by proportion of dividend paid out as earnings
No, proportion
under
of
dividend payout
earnings
ratio? Oh,
is not proportion of dividend, is the proportion of your earnings
paid out as dividends.
that is paid out as dividend. So just saying that you made an earnings of 10 naira, we're not paying 5 naira. So how much of your earnings is paid out as dividend? That's the dividend payout ratio.
So when you're now looking at dividend cover, is dividend cover in terms of percentage, or is it just a
Yes.
number? Because it's
Either
like
one
the flip.
is the reality for those ones is either one is fine. For dividend cover is more of the number of times, right? Is interpreted as the number of times your earnings can cover your dividend. Okay, so this one is the number of times. The number of times your earnings can pay your dividend. So you see it interpreted as it could be 2 times, could be 3 times, and all of that. Why this one would be in percentage would majorly be expressed as a percentage in most cases. Okay. Okay. And there could be more of them. So what I've tried to do today is to finish up with all the ratios. Then when we meet next week Sunday, we are going to solve past questions. You see a lot of other issues. Hopefully, that's what we're going to use. I can't see the whole of next week. Our first class on Sunday, I will compute this ratio. Then our second class, I think I want to teach you earnings per share, IAS 33 in our second class. I want to move to earnings per share immediately. Then when I'm done with that, then I can then start IAS 16 and all of that. But the reality is that by the time I'm done with this, like I told you in the afternoon, we'll have covered almost 30% of our syllabus looking at simple things. You know that so far we have looked at regulatory framework, conceptual framework, and we have looked at past question. You see that they ask it every diet. You go and check. Every diet is there. So we have also looked at another very important part in the afternoon. We looked at ethics in reporting, and I carefully taught you how to approach it. We looked at technology in reporting. I focused on key areas, and I introduced you to some recent technology like distributed ledger technology on which blockchain is built. And you know that cryptocurrency is built on blockchain, right? I also spoke about cloud computing, artificial intelligence, machine learning, and all that. But majorly, and I showed you some past questions, they ask it also. Majorly, we are focused majorly on what they ask, and the past questions is in this material for you to look at and appreciate, and solutions are also there as well. So those alone is like almost 15% or thereabout of your syllabus. And I told you I'll be inviting you for a class on Wednesday evening. If you can join, it will be very good for you. It gives us leverage, and we can cover more ground. So I'll use the opportunity to teach you sustainability reporting. So I'm teaching a class. So I'm looking at opportunity to combine us. Then we'll be looking at sustainability reports, which is like another 5% or so. And also, if you finish that early, we'll be able to also do IFRS 18 that is replacing IAS 1. There's high likelihood that they would ask this diet, because based on ICANN regulation, they ask a standard 6 months after its issuance. They didn't touch it last diet because it just came out, so it wasn't up to 6 months, but now it is over 6 months. Then it's likely going to be tested. They will just ask you the new changes and all of that, which I will touch on in our class. So with that, I've done, and ratio is like 20% of your syllabus. So as soon as I'm able to cover that and I teach you EPS, what is then left for me is standards and group account, which we are going to tackle head on. Group account is like 10% or even less of your syllabus, but it takes a long time to teach. At least it will take us like almost 7 contacts, 7 meetings to finish all the principles in group accounts, sub-past questions, teacher. It takes time, sometimes 8 self for me to finish. That's almost a month. So let's see how it goes. Let's see how far we would move on. I'll allow you go for tonight so that you can get ready for Monday. Do you have any questions for me?
The class you're saying about Wednesday, what time is it?
It's in the evening. It's in the same time we are doing today's class, from 8:30
Because I think we
to,
have class.
yeah, true,
We have
true.
Yes, we have
F-
class on
Yeah,
on
true.
weekdays.
That's true. You won't be able to join. For those of you that are doing, I think, FM, I think you usually have FM also. Or is it PM? Can't remember. Yeah, that's true. That's sad. It's okay. I'll see you next week. Bye.